This presentation will go over the basics of credit and credit cards. A credit card is something you may or may not be familiar with, but essentially it's a card that is issued to you by a financial institution, usually most often by a bank. What this card allows you to do is that it allows you to borrow money from that institution whenever you make a purchase. So that's a very important thing to remember because when you use a credit card, you're actually agreeing to pay back that money with interest, depending on the terms set by that bank. So this is different from a debit card, which is linked directly to your bank account. You aren't borrowing money in that situation. In this case, it is expected that you will pay back the money that you borrowed, and oftentimes actually pay back more when you include the interest. Some student credit cards are actually designed for college-age students who have limited or no credit history. And I'll go over what a credit history is in a second. We definitely understand that some students already have credit cards. Some may choose not to open any, but this presentation will just point out some important information. If you're shopping around for a credit card, you definitely want to look for things like a low interest rate or a low APR. It's sometimes referred to as APR, which is annual percentage rate. The lower this interest rate is, the better, because this means that you will be paying less money back on that money that you borrow. You also want to see if the card comes with an annual fee. Some credit cards will charge you a flat fixed rate in order to have that credit card. If you like to travel a lot, you definitely want to look for foreign transaction fees. Some credit card issuers will charge you if you use money or if you use that credit card overseas. Other kind of bonuses to look for with credit cards are credit monitoring tools and any rewards or incentives they may have. The one thing you want to be careful about there is that you're not overusing a credit card in order to get some of those rewards. When you use a credit card, again, this isn't free money. You're definitely expected to pay it back. So you definitely want to be sure that you're not spending more than you have. If you think you can't apply, you won't be approved for a credit card or you're not ready, one option could be to become an authorized user on a family credit card. There's also something called a secured credit card, which allows you to have some of this borrowing capability, but it comes with some protections. For example, it may limit the amount that you can purchase, or it may be backed by a bank account so that you're not, again, going over the limit you want to set for yourself. One resource I'll point out is there's a link down at the bottom for NerdWallet. It's a great resource with many articles and more information about credit cards, and it also has some really great credit card comparison tools. When you get a credit card, you start establishing something called credit, and this is measured with a number called a credit score. What this credit score does is it tells companies or financial institutions how likely you are to pay back any money that you've borrowed. The different factors that go into your credit score are your payment history. This is the biggest piece. They do want to see that you are making your payments on time. The length of your credit history. The longer that you've had an established credit, the better. They want to see a balance to your credit limit ratio. Most credit cards will issue you what's called a credit limit. So they're saying we're only allowing you to borrow or have a certain level of balance on your credit card. For example, if you have a credit limit of $1,000, that is the maximum balance that you can have on your credit card. The two other factors that go into it are types of credit used and any new credit. So if they see that you are borrowing or opening new lines, that does make you a little bit riskier. But again, as the biggest chunks to your credit score are your payment history and that balance. There are 3 different credit reporting agencies. There's Experian, Equifax, and TransUnion. They all use different formulas to calculate credit score. Most of the information is similar, but you just want to be, there are some slight differences, so you just want to be aware that there are 3 different credit bureaus. Ultimately, the higher your credit score is, the lower your interest rate will be when you try to take out a new credit card, a home loan, a car loan, etc. If your credit score, the higher your credit score is, that tells companies that they're not taking a big risk on paying on you when they extend you a loan. They are very likely to get their money back. Another thing to consider, and that does have an effect on your credit score, is hard pulls versus soft pulls. A hard inquiry or a hard pull happens when a financial institution checks your credit when they're making a lending decision. So when they're deciding to extend a loan to you or a new credit card. This could lower your score by a few points, but it's temporary. You just want to avoid having multiple hard pulls, so applying for multiple lines of credit in a short time, because this could lead lenders to consider you a high-risk customer. Soft inquiries or soft pulls, on the other hand, do not affect your credit score. This happens when a person or company checks your credit as part of a background check. So for example, if you're applying to for an apartment, or you're in the hiring process, those entities may just run a standard background check, and your credit score may come up. But again, these will not affect your credit score. One great free tool to stay on top of your credit score is Credit Karma. Credit is important because it helps you get what you need now. This is especially true for large purchases such as a home or a vehicle. It can take a long time to save up all of the money you need to pay it straight out of pocket. So getting a line of credit, applying for a loan is one way to get access to those resources now, rather than waiting and having to save up. This can, like I mentioned before, your current credit situation, your current credit score can help determine future interest rates. Length of credit history is one of the factors that does impact your credit score. So if you're looking to purchase a car or a vehicle at some point in your future, the length of time that you've had credit can help determine what your interest rate on that loan will be. And then most importantly, to have good credit, you want to be sure that you're paying your credit card bills or making loan payments on time. You want to try to keep a low balance on your credit cards. Usually you want to have no more than 10% of your total credit limit out. So if your credit limit is $1,000, you want to try to keep your balance below 100, for example. Use Credit Karma or some other free reporting tool to monitor your credit report. And as soon as you notice any indiscrepancies or any mistakes, contact one of the 3 credit bureaus to contest it. And then avoid too many credit pulls in a short period. So if possible, try to avoid applying to too many loans or credit cards in a short time.